Hello and welcome to Options Pro Strategies and Defense Tactics. This is John Summa, founder and president of OptionsNerd.com, online since 1998, presenting high-quality educational content to aspiring options traders. Without further ado, let's move into the material inside of our new DVD. And I'm going to begin with a little bit of an overview of what we'll cover. And I believe that you'll find this information valuable in all of your options trading, but particularly on the selling side. We'll cover two main strategies. First, we'll look at iron condors. As you can see here, I'm going to move my mouse arrow in. Iron condors, combination strategy, combination of a call credit spread, call options credit spread, and a put options credit spread. And we'll look at that strategy and a series of adjustment techniques that can be applied to that strategy. And then we'll turn to diagonal spreads, another one of my favorite options spreading approaches. And in a diagonal spread, we use a front month option, meaning a nearby expiring option, and we sell that option in the case of the diagonal spreads that I do. And then we combine that short front month option with a long back month option. So the back month option hedges the front month short option to an extent, depending on the deltas in the two options. We'll get into more of the specifics of these two types of strategies. And most importantly, the techniques I use to adjust them when they're being pressured by market moves against them. So let's take a peek at some of these defense tactics. And what you'll find here are some excellent ways to reduce risk while preserving the potential to make a profit on the initial strategy. So let's take a quick look at the iron condor defense adjustment tactics that we'll examine in this DVD. First, we have the butterfly roll. Butterfly strategy will be explained. It's a butterfly roll because the order you execute to adjust one side of the iron condor, whether it's the call or the put side, is a butterfly order, butterfly structure. And that will in effect, when combined with the existing positions you have in the iron condor, adjust that side of the trade in a way that will preserve the potential for profit. Another form of butterfly adjustment is the butterfly ratio roll. Now, we will not cover these necessarily in this order, but the ratio roll allows for the same outcome in terms of the general objective, that is to preserve the potential for profit in the initial strategy while reducing risk or removing risk from the immediate vicinity of the underlying as it has moved to pressure the trade initially. Third, we have the asymmetrical butterfly roll, another form of a butterfly order. And in this example, we will look at adjusting, again, the pressured side of an iron condor. And I'll explain asymmetrical. We essentially use different middle strikes in the butterfly to get one of the asymmetrical outcomes, and then we'll use a different higher strike for the other example we give for the asymmetrical butterfly roll. All right, and then we're going to move into delta reversal roll types. Here again can be applied to the put and the call side. And depends on the market pressure, whether it's on the call side or the put side. A very interesting approach that I think you'll find intriguing and well worth exploring in your actual trading. And we have the dynamic long option hedges tactic. Here we'll be able to drop in a ratio of long calls or puts depending on which side the market is pressuring, or in anticipation of pressure. We can begin to add long calls and long puts, and I'll show you how to do that while preserving the potential for profit on your initial trade. One of the things I should say here before we go to layered debit spreads, is that the overriding philosophy here is to keep the potential for profit in the trade and at the same time stabilize equity. How do we stabilize equity? Well, you'll see that common thread running through all of these techniques is that we will need to keep an eye on delta, that is the position delta. The position delta is a measure that we'll watch, a gauge, a risk gauge that we'll keep an eye on to see to what extent the trade will win or lose or gain or lose from a move in the underlying futures or our stock that we're trading. If we can keep the position delta small, meaning there's not much risk from movement, then we're able to mitigate directional risk, at least in the short term, medium term. We can continue to watch it. It will be a dynamic process where we'll keep an eye on that position delta and tweak it as we need to in light of what we expect in the market. Of course, all of this is aimed at preserving a potential profit from our initial strategy. And while it's not possible to always make money in your initial strategy, we may take small losses, we may get out at break even. That being said, the objective is to preserve that potential for profit, and that's the aim of applying tactics such as these that we're seeing here. Now, the layered debit spreads, the final tactical approach to our strategies adjustment, is the bull call spread and the bear put spread. So here we're taking a credit spread, say one side of the condor, and we're going to hedge it with a bull call spread below it. So we may do that to different degrees, meaning we will apply a bull call spread in a different ratio to the number of bear call spreads or the call credit spreads that we have in place. So we'll see lots of visual material. We'll get into details here and examples. And I want to move on to the diagonal spreads adjustment tactics before I wrap up this introduction to the DVD. Okay, so diagonal spreads adjustment tactics. Here we've got, remember, a front month option in this diagonal spread. A diagonal spread is a time spread or calendar spread that uses different strikes and different months for the options. A horizontal or classic calendar uses the same strikes. So in a diagonal, we have a front month short leg. Right? We're going to talk about how to roll those short legs, okay, when they're pressured. And we have a back month long leg that needs to be adjusted as well. We'll have to keep an eye on both of those. And there's a very nice tactic you can use to adjust both those legs and keep the potential for profit in there, and to at the same time to manage your risk. Now, there are also other related diagonal spread defense trading tactics we'll make reference to. One is called a roll in, and another is called a roll out. They are variations of our two types of front and back month, or the same type of adjustment we'll discuss for the front and back month. There's some ways we can adjust those adjustments, let's just say. And let's just leave it at that for now. An introduction to the topics to be covered in this new DVD. And what I'll do is begin with an iron condor structure, and we'll set up an iron condor and get the specs on it, and then we'll move into part 3, which is the techniques and tactics, defense tactics used to adjust that condor. Okay, again, this is John Summa, and I'm back in part 2 now of Options Pro Strategies and Defense Tactics. We'll set up an iron condor, also known as a covered strangle, in this section, and we'll explore its profit-loss parameters and take a look at how a strategy like this might be managed through the use of techniques that were outlined in the introduction to this DVD. Now, following the application of techniques to adjust the iron condors, which is part 3. Part 4 will set up a diagonal debit and credit spread. So we'll actually set up 2 types of diagonal spreads. And then part 5 will finish with an application of adjustment techniques to those types of spreads. So we have essentially 5 parts in this DVD, and we'll cover, as I explained in the introduction, the 2 strategy groups, iron condors and diagonal spreads. Okay, so without further ado, let's move into an iron condor structure. Now, the iron condor structure is a combination of calls and put spreads, credit spreads. And what I've done here is create sort of a prototype of the structure of the iron condor. On the call side, we can begin first here. We're going to work with groups of 5, and as you'll see, 5 lot trades. We're going to use the E-mini S&Ps as an example, or a market to illustrate the strategy. So I just want to say now that 5 E-minis is equivalent to 1 big S&P futures options. So those markets are fungible. That is, 5 E-minis sold is going to offset a long E-mini option. So that in your account would allow you to intermingle the trades and effectively make use of the ability to shave. I like to use the word shave delta with E-mini contracts if you're trading the big S&Ps. And if you have a large enough account, of course, you probably want to just stick to the big S&P options because you can apply all of these techniques just as well doing that one market. But you do need a large enough account. That said, these techniques and strategies that they're applied to can be used in virtually any market where you have options trading, whether it's ETF options such as the Qs, very liquid options there, or the spider options on the big S&P, the S&P 500 index, and the SPY underlying the options on the SPY. We can apply to stock options, big caps. You want to have, though, markets where the options have sufficient liquidity. And while I won't go into all of those fundamentals in this DVD, I might make reference to them. You would want to explore them and make sure you understand all those fundamentals before venturing into strategies such as these with the techniques I teach you to apply to them for defensive purposes. All right, sort of a digression here, but let's return to selling 5 out of the money. OTM represents represents out of the money, so FOTM, farther out of the money. So we're going to sell on the call side in our iron condor structure 5 out of the money calls, and we're going to buy 5 farther out of the money calls. Now, that's going to give us a credit. By definition, anytime you sell and buy options in this sequence, out of the money selling, further out of the money buying, you're going to have a price structure that gives you a net credit on that side. The call spread is going to generate a credit. Now, I put in 750 here as just an illustration. We may or may not get that much. It depends on the market we're trading and so on and so forth, and the conditions in that market. On the put side, in our iron condor, to complete the combination aspect of this trade, we're going to sell 5 the out of the money puts and buy 5 further out of the money puts. So we get a structure there that allows for a net credit on the put side, and for stylizing, I put in $750. Now that's calls plus puts, so we would combine this credit on either side to give us what's called our total premium collected in the iron condor, and that's $1,500. Now, the condor credit of $1,500 that we collect is not a guaranteed profit by any means. That premium does come into your account, and it's used in and applied to the margin required to open a position like this. What we need to do is defend this strategy with the techniques you'll learn in order to preserve the potential for profit. And we may not get 1,500. We may spend some of that in the defensive positions we take. And there's kind of a give and take here. Depending on market conditions, we may need to spend more of that premium in setting up our defensive techniques or our rolls, our adjustments, and so on. They do cost money, and that's going to come out of the premium we collected, and it'll eventually lower the rate of return. But the goal, as I said in the intro, is to preserve the potential for profit, however small, and in that particular strategy. Okay, so let's take a look at an actual iron condor, using some calls and puts on the S&P 500 E-mini options. Let me just explain a few things here. The 10 delta reference up here, you'll see a lot of that, and that's going to be a rule that I'll make reference to, and in order to it's a rule used to select the inside, what I call the inside or short legs in the condor. I also use a 20 delta. Now that just means that the short legs, when we select which strikes to use in the condor, will be either closer or farther away from the money. A 10 delta is farther away than 20 deltas. So in this case, we're using a 10 delta rule to select our short legs. Okay, so here's on the call side. We'll look at the price level here in a second. We're just going to look at the strike chain, go up the strike chain until we get to the 10 delta option, or closest one to 10 deltas, and we select that to sell. So that would be, in this case, the July 960 call, and we collected 320. The option was selling for 320, and we went up moving over here to the right to the July 980 call. We're going to work with 20-point spreads, and that's the distance between the 960 and the 980. You see 20 handles. All our spreads are going to be on the iron condors are going to be 20 handles, but the inside leg is always going to be either at the 10 delta or the 20 delta strike. So we had to pay for this higher up, further out of the money FOTM call, $1.45. Okay, and remember now the S&Ps, in the case of the E-mini options, each point of premium is $50. So we could translate this into the exact dollar numbers. I do that for you at the aggregate level, so we'll hold that for now. On the big S&P options, each point in premium is worth $250. Okay, so 5 E-minis equals 1 big S&P option. All right, now on the put side, we go down the strike chain and we identify the, again, 10 delta strike, and we sell that, and that happens to be the 800 put, and we collect 530 in premium times $50. Of course, this is going to be 5 of them. So I'm going to aggregate that for you, and then we're going to go down 20 handles more, just like we did with the calls. 20 handles, 20 points apart between the short and the long legs. We're going to buy the 780 put, and that is going to cost us 370. Okay, so let's do a little accounting here. On the inside short legs, call and put, 960, 800. We actually collected a total of 850, in points in premium, or $2,125. Okay, remember 5 of these. We're doing 5 of these, as we indicated in the previous slide. Now on the long side, we had to buy these, the 980, the higher, further out of the money call, and the further out of the money put, 780, and we total up the premiums and translate it into dollar terms. We had to pay $1287.50. Well, the difference between what we collect and what we pay is our net premium collected, and I have that up here calculated for you, $837.50. That's the maximum profit that the iron condor can make. Okay, it's not a guaranteed profit, and it's not one that will sit around through thick and thin try to actually lock down as a profit. We will use that premium when needed to defend positions, and we'll spend some of it in the hedging, repairing, adjusting, defensive tactics that you're learning here in this DVD. Okay, so there's our 10 Delta Iron Condor prices and legs. Let's take a picture of that now. This is using Option View 6 options analysis software, and we'll definitely be using a lot of this analysis. You'll see a lot of these what are called profit loss diagrams, and I'll give you a little tour of this so you understand it before we go through all the others. But here we have our July 10 Delta Iron Condor that we just set up. So let me just back up here. Okay, so we've got our 5 July 960 calls those are the inside legs. We sold those, and we bought the higher up, further out of the money, 5 of the July 980 calls. Okay, so that's our call credit spread side. And remember, we bought 5 of the July 780 puts, and we sold 5 of the July 800 puts. Now in here there's no CEV modeling. What that means is we're not going to model in this slide the effects of the change in volatility in the premiums resulting from movement of the underlying. And in the next slide you'll see that is actually turned on so that we can get a more realistic simulation of the P&L, profit loss here. And okay, so now all those legs are also right in here. Okay, they're loaded in, and we're going to analyze here. Now this solid line is our profit loss at expiration, and as you can see there's limited loss and limited profit potential in this trade. And I've just going to back up here. This mouse is very sensitive, so it moves without much effort here. T plus 0 is the entry point P&L. That's the lowest one here. The 7 days into the trade, 13, 20, and 26 expiration. Those are calendar days. So T plus 7 is this next plot, profit loss plot. T plus 13 is this higher plot. So these are looking at the profit loss payoff, or the losses or payoff for profit at different time intervals in the life of the trade. So we start here. Entry price level is 888.50. Should have said that in the previous slide, but that's at the level of the underlying when we selected our strikes using the 10 delta rule. So now we've got our at expiration P&L. We've got our intervening time frames P&L. Here we have our margin requirement, 2,714 for 5 of these. This would be the same margin, by the way, if you did one big S&P Iron Condor using a 10 delta selection rule for the short strikes, and a 20-point spread between the short and the longs. Expiration date, July 18. Break-even points actually these break-even points we'll ignore for now because they're giving us misleading break-even because it's looking at the T plus 0 plot. Okay, we are short some volatility here. Vega is negative. That means an expansion of IV will affect this negatively. It's positive theta, meaning that we've got time decay in our favor, which is the whole objective here. We're gaining $35.99 a day in time value decay, other things remaining the same, ceteris paribus. And we have our slightly short delta, but we're gonna watch that delta because it's going to actually change when we go to CEV modeling, which I'm going to do now. We'll move over to the next slide. And here, when we turn on CEV modeling, we see the delta is actually closer to neutrality, which is what you typically get in an iron condor set up symmetrically, using some delta rules such as the 10 delta rule to select the inside legs. And if we use the same distance between the short and the long leg on the call side, legs on the call side and on the put side, we should have close to a neutral delta. So there it is. And you can see it's sort of, we can just back up here and we can see that the delta is definitely, the negative delta is definitely taken out of there significantly, pulling up or flattening out of this region a bit here. And you can read it here at the entry point. Of course, that doesn't mean it's going to remain in single digits. We want to watch that. It's nice to keep it in single digits, but of course, there's no way to do that permanently. But we can, as you'll see, when we apply techniques such as the ones indicated in the intro to this DVD, we can take out as much of this delta here at any one of these time frames with some simple adjustments and still have plenty of potential profit in the trade. So just a recap. We set up with our 10 delta rule. We selected our strikes. We got the prices and the total package price for this trade, and then we take a picture of it here, and then we put on some CEV modeling, which by the way is known as constant elasticity of volatility. It's a function in Option View 6 that you can turn on for modeling purposes. You don't need this necessarily to trade, but in modeling and teaching you the effects of the movement of the underlying on the strategy, you need to have some of that volatility better modeled. What will happen, just in case you don't know, and I teach this in some of my other seminar and webinar events, is that the price movement of the underlying futures, which is trading on the SPX, the S&P 500, is inversely related to volatility. So a move higher along the price axis here, if we move higher, we're going to have falling IV or prices of the options. And on the downside, we're going to have rising IV, or options are getting more expensive overall. The market's getting more expensive. So it's an important dynamic, and that can be modeled as we do here. All right, so let's take a look at the legs inside the options matrix. Here we have our price level, 888.50, sorry. And we have our legs in here, the 970, 990, but note that they're different from the ones we just set up. I'm going to come back to that in a second. The legs that we're working with are actually 960 and 980 on the call side, and as indicated here, the 800 and the 780 on the put side. Now, what's interesting here is that because we had some delta that I felt was a little bit too much negative delta on the initial setup of this trade, I moved after we set it up. I decided, well, let's use these legs, 970, 990. We'll move 10 handles, the whole spread 10 handles higher. We'll collect less premium, actually around 688 as indicated here, but we'll also shave off some of that delta. Now it's showing us here -5 deltas. It's a little bit less than we saw in the previous slide. Let's go back, we can take a look at that. You can see -6.39. So that was with our calls using the 960 inside leg and outside leg 980. So what I'm doing now is I'm shifting this whole structure higher. So we're using 970, 990. Still 20 handles space between the two, but we just shifted the spread up to take out some more of that short delta. So that's going to more balance or better balance the initial trade. The initial margin requirement is 2,300, and if you go back, I want to just compare that, show you that it was 27.46. So we also took down a little bit of our margin requirements to set this trade up. This is very useful, I think, for you to see that ways in which you can sort of make an adjustment even before you get the trade going, getting it set up properly, and what the margin requirements will be. If you want to take on less risk, you can move the call side up. A couple of points here I'll just allude to. If you have a bullish outlook on the market, even though this is in theory a non-directional trade, you may want to do what I just did on the call side and move the calls spread higher in anticipation of a continuation of a bullish trend. There's no sense being in the trade perfectly neutral or very close to neutral from a position delta point of view if there's a fairly strong bullish trend. Okay, so you may want to adjust the selection of the strikes for the call side or the put side depending on your outlook on the underlying, technically speaking. We can still apply our adjustment techniques. And in this case, there was a bullish a tendency in the market, although it wasn't. It was very overbought and was looking for. Well, there was actually a big drop that day, so my sense was that the market was going to attempt to run again at the highs it had recently established. Whether you're right or wrong is not necessarily a game changer. Really, you're just allowing yourself some extra wiggle room. You don't want to get away from the non-directional trading approach here and get into a directional approach, because then you run into other problems. But direction can be incorporated, or discretion, about direction can be incorporated into the selection of strikes in a small way. You don't want to go crazy here, okay? All right, let's move to the next slide. With our higher call legs now, recall that we used a 960 for the inside and a 980 for the call, and the 980 for the long side. And now we've, as I showed you in the previous matrix, we've moved those legs up 10 handles. So we now have in our condor a 970-990 call credit spread with our initial 800-780 put credit spread. And that changes, the values that we took in. We now have 687.50 as a credit. Okay, so let's move on to the next slide. What we're going to do here is take a look at the 970, 990 in the picture. Okay, we've got our CEV modeling on. We're looking at the T+0 time frame. So here's our condor with a $2,300 margin requirement. 5 lots or 1 big S&P option would be the equivalent. And that's the completed setup picture of the P&L of the Iron Condor. Okay, so the delta has come down. It's actually flattened out here in a better way. Of course, it's going to turn against us if we move either way. It's going to turn delta short more and more on the upside, and delta long more and more on the downside. And we'll need that's what we mean as pressured, and we'll need to make adjustments. The subject of part 3 in this DVD. Okay, we are back here for part 3. This is John Summa presenting Options Pro Strategies and Defense Tactics, butterfly rolls we'll begin with, and then we'll move into some of the other tactics I use for defending an Iron Condor on either the call side or the put side, depending which side is being pressured. Okay, so let's look at a simple butterfly roll. We'll start with the original call spread here, as you can see. Bring up my mouse arrow. The structure, of course, is short calls that are out of the money and long calls that are farther out of the money. And we're always working with 5 lots here. These are 5E minis. You'll see when we get to the actual examples. But here at the prototype level, we'll abstract from the market itself, and we'll look at the just the legs in a spread on the call side, and then the adjustment with a butterfly spread order, and then the resulting new higher call spread. That's going to be the result. So let's see. We've got our 5-lot call credit spread here. When we apply a butterfly spread order, we're going to get a P&L with a higher break-even point at expiration. That isn't here seen. We're going to show that in the next slide. Once we apply this spread to our butterfly spread to our original call credit spread, and we'll walk through the legs here, we'll end up with a higher break-even point. So there's a sequence here to demonstrate this technique. I'm going to back up through our slides and walk through this in detail. Just want to give you an overview first. So when we choose the butterfly spread order spread legs, we want to make sure we're matching the lower legs and the middle legs of that butterfly to the legs in our original call spread, or if it's a put spread, we're defending and adjusting the puts in the butterfly spread order. Or if it's we would be using a butterfly spread order with put, so we'd have a higher put, a middle lower put, and then the lowest of the puts in the butterfly spread order. In this case, we're using calls, so we would match up the lower and the higher, and as a result of that, we got to buy 5 and sell 10 as we would in a butterfly. We're going to offset our short calls in the original call credit spread, which is the objective, reverse the original longs here because we're selling 10 of them, getting a short 5 OTM2 I call this, out of the money, or OTM2 out of the money 2. And then when we drop in the extra long, 5 long calls here, the higher strikes in the butterfly spread order will end up with long legs above our new short legs. So we've got here a new call credit spread. 5 short calls, OTM2 here, and 5 long calls, farther out of the money 2. Okay, to distinguish them from the originals, OTM and FOTM. It's very simple. One order here, this spread order, executes a roll of the original spread from the lower strikes to higher strikes. There you have it. And when we get pressured, in this case using a February iron condor, which I'll explain in a second, when we get pressured with the market move higher, in this case up to 871.50 from about 800 when this was put on, we're going to need to make an adjustment. Now, the original position had 5 February 875 short calls. Okay, those are the ones that will be offset. The long 5 Feb 895 calls, as we saw with the application of the butterfly spread order, these will be reversed short. So we'll be short 5 of the 895s. And then we'll drop in 5 longs up at 915. So that we'll have a new call credit spread moved higher. Our puts, meanwhile, are not going to be adjusted. Let me just say something about the put side when we're talking about the call side and moving that call spread higher or adjusting it or taking down the risk and some of the other ways you'll see. The call spreads, or if it's adjusting the puts and the put spreads, the call spreads on the other side that are winning, I'm not going to deal with making adjustments to those. However, they can be rolled with the trade, so they can be, you can take down calls lower, you can move put spreads higher with the market move to take in a little bit more premium on that side, but I would say be very conservative there because you don't want to have the market forcing adjustment on one side and then turning and within a few days forcing adjustments on the other side, and you're getting kind of whipsawed there in the market. You really want to try to avoid that as at all costs. And the temptation is to try to keep credit coming in to match the debits, which is a good goal, but it's probably better to give back some of the credit, and you'll see we give back different degrees of our original credit, which in this case you'll see is a significant chunk of it, but certainly by no means turning the trade into a mediocre winner. It will be still a significant winner. And let's say, for example, here we see our net premium collected is 2,040, and that's the case here. When the call side is pressured and we make this adjustment we're going to do, you'll see that we're going to give back some of that $2,040. How much? Well, that depends on the type of adjustment we do and when we do it. So let's just recap. We've moved up to 875 and 871.50. we ran a February iron condor. The calls on the inside legs, the 875s, are going to need to be offset and rolled rolled higher. And here in this next slide, in the options matrix, in option view 6, options analysis software, we apply this butterfly spread as we had outlined, and matching up those strikes, and the lower in the middle with the original lower and higher of the call spread. And what will result is an offset of the original short. This will be reversed, net short 5 and long 5 up at 915. And we're still left with a sizable profit. If this were a 10K account, which is an account size that would be adequate for trading 5E mini iron condors of this nature, we would have still about a 13% profit potential for this monthly writing plan. So not bad. Even if we need to adjust again and give back some more of that, it's going to still have the potential for profit, albeit smaller. And here we have kind of a summary of the adjustment. Original credit collected here, the net premium collected pre-adjustment was $2,040 for the put spreads and the call spreads, the iron condor. And this is a 10 delta iron condor. Remember in part 2 we talked about the delta selection rule. The 10 deltas for the inside legs of the iron condor, or 20 deltas, which we'll use later, and then using 20 handles between the strikes, and that pretty much gives you the selection criteria for the iron condor. And then post-adjustment, net premium collected $1,352. So we gave back some of that initial credit in this adjustment here. And here you have the prices total. Actually, we paid for the 5 Feb 875s to offset them, and then we collected $6,875 when we sold 10 of the Feb 895s, 5 of which we already owned. And then we went prior to the 915s and we bought 5 of those and paid $1,875. When you net all this out, you come up with a cost of $687.50, and that's going to be a debit cost, and that comes out of our initial credit. So we've got a credit and a debit, and that leaves us with $1,352.50. There's some minor differences here in price of a few dollars on that net premium post adjustment. We'll just disregard. It's a couple of bucks, and that's pretty much where we're going to come in here with the post adjustment net premium. Again, if it's a 10K account, we're talking still about $1,300, commissions aside, and that's about 13% of invested capital in the trading program. So still not bad. If we end up adjusting this again, we may give back another portion of that, but that's the game plan. We want to give back as little as we need to, but we will give back that premium to defend our positions. We want to let the market dictate to us what to do. Let the market be our guide. We don't want to fight the market. We want the market to indicate to us it's time to adjust. And that's a sort of philosophy of moving with the market, not fighting the current. Okay, let's identify where that market's moving, and when it gets to a certain point, we need to move with it. Okay, so February 10 Delta Iron Condor here. This is the picture of the adjusted Condor. Our original Condor was adjusted, and we did that with the butterfly adjustment, butterfly spread order, and now we are short 5 Feb 895 calls. Those are higher. Those were the original long legs in the call credit spread that were reversed. Now they're short legs, 5 of them, and we're now long 5 higher calls in February 915. Okay, so that's a new call credit spread. Essentially the old one rolled higher, leaving us with a higher break-even point as indicated here at about 900 and change, 950. So that's remember, we're at 871.50, and when that adjustment was made, and that's given us some more wiggle room here, and it's kept our margin from getting too big. We want to keep that margin down in that vicinity. I could talk a little bit about margin usage, but you should use 50% of margin as we're not there yet if this is a 10K account, as a definite red flag to try to take down risk. Okay, so that is with 12 days remaining on this trade, a new P&L. The expiration P&L is highlighted, and we've got a higher break-even point, and we've got a potential profit of $1,352 in this adjusted Feb iron condor. So there you have it. That is the first of our adjustment techniques. It's not rocket science, but it does require some diligence in application, and you should definitely paper trade these at first and get a feel for them. You can do some simulating without actually paper trading, but definitely try to do some paper trading and work with some smaller e-minis with some real money as a graduated step, and apply these with some real money to get a kind of gut feel for the application of these. It's always good to put a little money at risk to get a feel for that. Okay, so adjusting a condor, again here we're going to look at a second type of butterfly roll. It's an asymmetrical roll. Simply, an asymmetrical roll refers to using a different distance either between the strikes, either in the spread order that's put in, or getting the outcome, a butterfly outcome with different distances between the strikes. In a classic butterfly spread, you've got a lower set of long legs and a higher set of long legs that have the same number of legs, and then you have a middle set of legs that are the short legs, and those short legs are going to be the same distance from the lower long legs and the higher long legs. Okay, so that's symmetrical. When we mess around with that structure and increase the distance between the short and the longs, either the lower longs in the middle, lower and in the middle, or the higher in the middle, we're creating an asymmetrical structure, as you'll see. So here again, working with our call spread side of the iron condor, we apply a butterfly spread order, but we've now not matched the middle strikes and in the butterfly spread to the original call credit spread, and this mismatch, as you can see here, by moving 10 handles higher, creates a butterfly spread that's asymmetrical. We're not using the same distance here between the strikes. In fact, the outcome is going to be a butterfly spread structure, not a call credit spread, but a butterfly spread structure with an asymmetrical side to it. We have 10 handle difference between our long and shorts, okay, and a 20 handle difference between our middle shorts and higher longs. All right, so that's going to be the asymmetrical part of it. Well, let's back up and take a closer look at the new rolled call spread at the prototypical level. Here, when we apply this butterfly spread order with the mismatch in the middle strike, we leave the long legs in the original call credit spread in place. As you can see, they're not offset or reversed. The short calls, the out-of-the-money calls in the original call spread, however, are offset. Okay, that's the same, but we don't offset the long legs. So that leaves now 5 long calls below 10 short calls that are 10 handles higher than the long legs. Remember, we went 10 handles up above. And then above that we have our 5 calls, the FOTM3. So this leaves intact now not just a rolled, it's a rolled spread, but it's actually a butterfly spread left over. And that's going to create an interesting outcome. We've gotten rid of the original risk in the short legs, and we've got long 5, 895 calls, short 10, 905 calls, and long 5, 925 calls. And we're at 871.50, same price action. And but down here, note that we've given back quite a bit of our initial premium, and we have only the potential for $162 in time value credit in this trade. But there's more to the story. That minimum time value profit has shrunk, so we don't have much there. In fact, we don't have to sweat it much either. We've got that in there as in the bag if the market doesn't move anywhere. Our margin is kept. Oops, jumped ahead there. Sorry about that. Our margin kept stable, 2,500. We have, however, put in a profit tent, and we've moved our break even higher to 915.75. So we have potential to pull out some higher profit, and that will occur if we land inside this tent at expiration, and that's at 12 days in from the adjustment point. So great news is that the break-even has been thrust much higher. Remember, it was 900 and change in the previous adjustment. We've got that higher now. Of course, we've given back a lot or most of our premium, but we've got the potential to have the market move into the profit tent, and that can happen in expiration week where we could pull out potential profit there in one of the last 2 days of trading. We don't have to wait right to the bitter end to see if we land in the profit tent. Sometimes you get a move through the tent or into the tent temporarily, and you can take out a profit there. So here you see in the second example of a butterfly roll that's asymmetrical, we have a quite different outcome with a profit tent that sits above the current level of the market. So any move up there could produce a windfall potential profit. All right, now moving to another asymmetrical butterfly roll, call this roll 2, and the third example of adjusting a condor with a butterfly. And we see we begin with the call spread here, and we apply a butterfly spread order, and we do match up the lower and the middle butterfly spread legs with the call credit spread legs in this case, but we're going to use a higher set of strikes, or strikes, sorry, for the higher strike in the butterfly spread. So we're going to increase the distance between the middle and the higher strikes. Here's the middle, here's the higher. And we're going to have 5 long legs that are further out of the money, call them FOTM2. We're going to have a call credit spread left over, but the distance between them is going to increase. That is the distance relative to the original distance of 20 handles.